Hi, and welcome to Alpha Beta China in Depth, the latest in a series of educational webinars developed by IndexUniverse. I'm your host, Allison Jones, Director of Conferences for IndexUniverse, and we're pleased today to be joined on the call by Burton Malkiel. Dr. Malkiel is a professor of economics at Princeton University and author of both A Random Walk Down Wall Street, one of the most seminal documents of modern portfolio theory and index investing, and From Wall Street to the Great Wall, which introduced many investors to the Chinese markets for the first time. He's also the CIO of AlphaShares. We also have our very own Dave Nadig, Director of Research here at IndexUniverse. This is the latest in our monthly series of webinars we call the Alpha Beta series. For these webinars, we partner with leading portfolio managers to provide complete 360-degree analysis of how to invest in different asset classes using ETFs. The format today is very straightforward. Professor Malkiel is going to kick things off with a 15-minute presentation covering the case for China, including directly addressing some of the negative arguments. He's covering the alpha of the series. We'll then bring Dave Nadig in to the discussion to cover the beta presentation with his own 15-minute series presentation on understanding, evaluating, and trading the very different types of China ETFs. Following Dave's presentation, there will be a moderated Q&A with both. As a participant in this webinar, you can enter questions for any of the panelists using the Q&A tool at the bottom right-hand corner of your webinar screen. Please don't wait until the end to ask questions. You can submit them as they occur to you. We'll collate questions submitted throughout the webinar and answer as many as we can at the end. With that, I'd like to hand it over to Dr. Malkiel. Burton?
Thank you very much, Allison, and it's my pleasure to present the case for China. If we could go to my first slide, now this is kind of a little known fact that most people don't realize that in 1820, China had probably about a third of the world's GDP, about a third of the world's economic activity. It was not only the most populous country, the one with the greatest landmass, but also was an economic powerhouse. The next 150 years were nothing short of a disaster for China. In the 1800s, they were beaten in a couple of so-called opium wars. In the 1900s, they were invaded by Japan, which was not kicked out of China till the end of World War II in 1945. There was then a very damaging civil war, and then a long period under Mao, which I would call a failed period of communism, which, as you can see from China's percent of world GDP, really failed to move the needle at all. And then came this remarkable transformation. This remarkable man, Deng Xiaoping, who was everything that Mao wasn't. Mao was an ideologue who nationalized everything. Deng was basically an intensely practical man. Deng would say, I don't care if the cat is black or white, just that it catches mice. Are stock exchanges useful? Well, I know they're not communist, but let's see if they work. And basically what Deng did was to introduce, or if you wish, reintroduce, because there was a form of capitalism earlier, capitalism into the country and basically unleash the enormous energy of the Chinese people. people. You see it with the red bars on this chart. If you look to the next one, you will see the growth of China's GDP, and these are IMF statistics during since the transformation of Deng Xiaoping. Now, what is important is not only that to see this growth, but it is simply unprecedented in world history. There is no country during its growth phase that has ever grown anything like the way China grew. The U.S. didn't do it during its growth phase. Europe didn't do it during the Industrial Revolution. Japan never grew at these kinds of rates when it appeared to everyone that Japan was going to bury us. This is simply unprecedented in world economic history. Well, the question, of course, that you are interested in, and we'll sort of start that on the next slide, is this going to continue? And my view is that it will continue, because China's a very funny country. It's called an emerging market, a developing market. If you go to the east of China, where Beijing and Shanghai are, you see a quite modern and developed country. But the center and west are still dirt poor. And there are hundreds of millions of educated potential workers who see the riches that have been created in the East. They've seen how millions of people have been raised out of poverty. They are very restless. There is, periodic uprisings in the center and west, and so government policy has, as a policy, we've got to raise these people out of poverty, if for no other reason than to keep us in power. And China's got the wherewithal to do it. They have a very strong balance sheet. They have over $3 trillion of reserves. There's low government debt. There's low personal debt. For all the talk about Chinese banks being in trouble, they're in much better shape than U.S. banks. And one thing that the Chinese government can do is increase or decrease bank lending quite rapidly. And the Chinese fiscal policy has, in my view, been very much better designed than our fiscal policy. I think one of the reasons why our stimulus policy didn't work terribly well, and we still have 9% unemployment, is it really wasn't designed well to increase employment. It was, in some sense, a bunch of earmarks, the way Congress did it. Whereas the fiscal policy in China is concentrated on, we've got to develop the center and west, and so we're going to build the infrastructure, we're going to build the power plants, we're going to build the cities, we're going to build the railroads, we're going to build the roads. And that's what Chinese fiscal policy has done, and been very, very well designed, I think, not only to mean that China basically escaped the worldwide recession, but that China can continue to grow as the center and west are developed. And I'll return to the point about the Chinese consumer in a moment. So let's go to the next slide, though, and just see IMF estimates. And if you look to the right, these aren't my estimates, these are IMF estimates, and basically what the IMF is suggesting is that when you adjust for purchasing power parity, that China is going to exceed the size of the United States by the middle of this decade. So let's now, we know that there's a lot of negativity about China now, and as the next slide suggests, there are a number of prominent bears on China. So let's look at some of these arguments. Jim Chanos, who I think is really talking his book, says China's the new Enron. It's Dubai times 1,000 on a treadmill to hell. chancellor of the Grantham Mayo organization says there's a great speculative mania. There's going to be a rude awakening. Mark Faber, who does the gloom and doom report, says a crash is likely in the next 9 to 12 months. Actually, he said this a year and a half ago, but he keeps telling us that there'll be a crash in the next 9 to 12 months. So let's look at the arguments of these China bears. And the next slide, I think, summarizes what the negative arguments are. One, it's argued there's been a lot of overinvestment and there's enormous overcapacity. The second argument is there's been massive increases in bank lending, and that's produced asset price bubbles, and there's going to be a financial crisis. And the third argument that the bears use is actually, I've taken this as a quote from the Premier Wen, that the Chinese economy is unstable, unbalanced, and unsustainable. And that's even what the Premier has said. So that certainly leads some credence to this argument of the bears. So let's look at these arguments. As the next slide shows, there's no doubt that China has been on an investment boom. Investment is an unprecedented share of GDP, and it has led to some overcapacity. You do see in shipbuilding there's overcapacity. There's probably some overcapacity in steel. And when you have investments of that size, invariably this leads to diminishing returns on investment. Now, the other thing that happens is, and a lot of this investment has been government investment, is that there's been overbuilding in infrastructure, according to the bears. What the Chinese government has done, it has actually built cities in advance of people leaving the farm. Cities in the undeveloped parts of the country, and the argument is that they are ghost towns. The argument is that these highways and high-speed railways to the center and west are bridges to nowhere. So let's go to the next slide, and let me give you my arguments as to one of the reasons why I am not worried. It is inevitably true that with high growth economies there are temporary excess capacity. I remember when I first came into Shanghai from the new airport. It was at night, and we went by lots of apartment buildings with no lights, and I said to my host, well, you know, what does anybody live there? They said, no, we just built them. There's nobody there now, but we expect that they'll be occupied. And my next trip to China, which was only about 8 months later, came back at night again as I did before, and there were lights on. So, yes, there's excess capacity, but there's also enormously high absorption. And you can have 20% excess capacity in a 10-11% growth economy, and that's much less of a problem than the kind of excess capacity we've got in the United States in a 2% growth economy. And that excess capacity is with this infrastructure. I think the government knows exactly what it's doing. It's got to bring development to the center and west that will more evenly distribute income and will ultimately support faster consumption growth. So, yes, there's excess capacity, but I believe it will be justified. There's always been excess capacity in China, and that is typically what happens in a high-growth economy. Next slide says that there's, and this is the other bear argument, that there was massive credit expansion. The money supply grew by 30% in 2009, and bank lending increased by an amount that was 30% of GDP, and the bear argument is, inevitably, this means asset price bubbles in property and stock prices, and will ultimately increase the non-performing loans in the banks and risk a credit crisis. So let's go to the next slide, and let me give you my arguments why, again, this is not something that I think is likely to be a major problem. First of all, what it doesn't admit is that the government was well aware that the growth was too high in 2009, and they began to slow lending growth in late 2009. Reserve requirements have gone up 5 times in the last during the last 6 months. There are leverage limits on the banks. Interest rates have gone up a bit, and even if there is a property bubble in some areas, and I think there's no question about the fact that real estate prices have been rising rapidly, this is not likely. You know, people then say, look what happened in the United States when this happened. It's not likely to be nearly as damaging as it was in the United States. What our asset price bubble was a problem because debt levels were high. People were buying houses with nothing down. They were buying second houses. We were making ninja loans to people with no income, no jobs, no assets. There is much less leverage in the Chinese property market. If you buy a house, you put 40% minimum down payment. And if you buy a second house, and some people are doing it, you put 60% down. So even if, and I'm not going to tell you that there aren't some areas where probably there's been some speculation in real estate, it has not been financed with debt and therefore is very much less dangerous. Because, for example, in the United States, debt to GDP is 90%. In China, debt to GDP is 17% of government debt. And for consumer debt, consumers have $1.30 of debt for every dollar of disposable income. In China, it's 34 cents for every dollar of disposable income. And the non-performing loans are much lower in U.S. banks than in Chinese banks than they are in U.S. banks. And even if they do get out of hand, and they have in the past, during this big growth phase, in the first decade, there was a period when the non-performing loans got out of hand. Remember that the banks are half owned by the government, and the government simply injects funds into the banks. And if you consider bank debt to be the equivalent of government debt, and I think that's probably not a bad way to think of it, if you simply assume all the bank debt is government debt, the debt-to-GDP ratio is only 30%. It's still not the 90% that we have. It's not the 150% that Greece has and the over 200% that Japan has. And in terms of a bubble in equity prices, if you look at the next slide, there's no evidence that equity prices are too high. On the Guggenheim AlphaShares all-cap ETF YAO, you have a 15 price earnings multiple. On the small caps now it's 13 times, and so the PEG ratios, the PE to growth rates, are extremely moderate. You can't look at some of these things and say that there has been a bubble in stock prices. Quite the contrary. Stock prices have been very weak, and I think give people, I'm not a market timer, but certainly give people an opportunity to get in at reasonable multiples. Now, the next slide gets the last bear case, that the growth has been unbalanced and unsustainable, because the growth in China up thus far has depended on exports and investment. And the Premier is absolutely right. This is unbalanced and unsustainable, because the exports cannot continue to be so robust in a world suffering from double-digit unemployment. You know, the United States isn't going to allow for it. That's why we call the Chinese currency manipulators. There's always a chance of protectionism. The feeling in Europe is even stronger. they simply can't rely on the export machine to the same extent, and they can't rely on investment to the same extent. The returns on investment are going to continue to decline. But if you look at the next slide, China's got an ace up its sleeve. Consumption's only a third of GDP, and part of the stimulus plan, and this was, I think, the very smart thing that they did, was to create the beginnings of a social safety net. One of the reasons, it's a kind of paradox of communism. Here you have a socialist communist country with no unemployment insurance, no social security, no health care. And it's one of the reasons why people save so much. So what they have done as part of the stimulus plan is to start a social security system, to start an unemployment insurance system. They hope that by 2020 there will be medical coverage for everybody. And they are now using tax policy to stimulate consumption. And as Stephen Roach of Morgan Stanley was arguing, and this is something that the government has definitely taken to heart, one of the things that China has a very inadequate service sector. The good thing about service industries is they don't belch smoke, and China certainly has a pollution problem. They create good paying jobs, and you are starting to see, as Steve Roach has argued, software demand, medical technology, some of these things coming up, which creates good incomes, and again, this labor-intensive growth will help absorb the millions of still unemployed people and encourage consumption. So let's go to the next slide and just talk about some very recent worries. Is there going to be a hard landing? We do know that the Chinese are trying to slow the economy down. They do have an inflation problem. The inflation rate's been about 5% the last couple of months on an annual basis, and this is too high and well above their targets. And they are reining in the economy, and a lot of people say, oh, hard landing, this is the end of the growth. Well, it will slow down. The growth was 10.5% last year. According to the IMF, it'll be 9.5% this year. Maybe it'll only be 9%. And I remember having a debate with one of the China bears and saying, you see, what a stop-and-go economy. Well, let me tell you, if a stop-and-go economy is you got 10.5% growth and then you go down to 9% growth, boy, that's the stop-and-go economy I'd love for the United States. And the inflation was largely in food and fuel. It very well may have peaked. We've seen the oil price go down recently. If, God willing, we have good crop years, and we had terrible crop years last year, we're going to get some help on the inflation front. And one of the policy tools that China has, since the inflation's all been food and fuel, is it gives them more pressure to let the RMB appreciate, because that means that the oil and the food they have to import costs less. You know, there's a positive to this inflation, and it's, I think, one of the reasons why the yuan or RMB has been appreciating at a somewhat higher rate, and I think is going to continue to appreciate at something perhaps at a 5% rate. So I don't see the hard landing. Yes, it's slowing down, but even if it slowed down to 8%, this is not a hard landing in my view. You're still going to see growth because the government absolutely wants to keep a lid on the kind of social pressures that you see in the center and the west. There's also been a lot of negative publicity concerning accounting regularities. I would just say on that, most of these problems have involved the reverse mergers. I think you are seeing the SEC now come down on this like a ton of bricks, and I know on our Guggenheim AlphaShares ETFs, we religiously avoid any company that's been basically created via a reverse merger. What about a jasmine revolution? I mean, we've seen North Africa erupt, and last week there was a front page story in the Wall Street Journal, "Wave of Unrest Rocks China." Well, I think there's a big difference between Egypt and China. In Egypt, you have none of the people think that things have been getting better. They can't expect that there's going to be employment. Young people can't expect that there are jobs, whereas the people in China know that growth has lifted hundreds of millions of people out of poverty, and the growth continuing is just what the government wants to do. And again, unlike places like in Saudi Arabia where all of the benefits, or most of them, go to a small royal family, the one thing about the Communist Party is it's quite democratic. I mean, there isn't just a couple of leaders. There are 80 million members of the Communist Party. And I don't see a jasmine revolution basically bringing an end to this. I think growth is the policy they need to prevent it. And just remember, China also is very effective. They spend more on internal security than they do on external security. So just a couple of more points. The next slide, just to show you, China's RMB is still the most undervalued currency in the world. And if you buy companies that earn their money in RMB, I think you're buying a currency that has only one way to go up, and that's to appreciate. Very unscientific way of doing it. The so-called Big Mac index. You take the same product priced all over the world. A Big Mac costs $3.70 in the United States. If you go to Paris and buy it on the Champs-Élysées, it's $4.70. If you buy it in Shanghai, it's just over $2. Very unscientific, but it gives you an idea of why, on a purchasing power basis, the RMB looks pretty good. Last slide. I'm not telling you that China doesn't have problems. It does have problems. But even if some real estate markets are overextended, as they may well be, calling for a collapse is, I think, wrong. I think it's very unlikely. The growth will inevitably slow. You can't keep growing at 10% a year, but it's going to continue at high single-digit rates for at least another decade. At least the stock market shows no signs of being in a bubble, and I think the bears on China have it wrong. Sure, China's got problems, but my own feeling is I'm much more worried when you sort of think of the Greeces of the world with so much debt, and you look at the fiscal position of China. I remain a China bull and believe that the negative arguments are way overblown. So that's the end of my presentation, so let me turn it over to Dave.
Thanks very much, Professor Malkiel. I really appreciate that. You paint a pretty compelling case, I have to say. In my brief presentation, I'm not going to be talking about the bull or bear case. I'm going to be talking about the how. Right? I'm going to be talking about what you as an investor can do if you believe this positive case for China. How can you actually access it? I'm going to go even one step further and say that even if you're already bullish on China, you're probably still underweight in China. And I would go so far as to say that even index-based investors with an Asian strategy are systematically and unintentionally underweight in China, and need to consider that when they're choosing the kinds of products that they might be using to access these markets. The thing to understand about China from an ETF investor's perspective is that China is different, and it's different in two pretty fundamental ways. The first thing to remember is that China is or was, at least recently, a thoroughly communist country, and what that meant was that most of the major companies that we as U.S. investors would think about wanting to own in our own economy were in fact owned almost entirely by the government. And although it's 30 years into this economic liberalization, it's still the case. China Mobile, for instance, the world's largest mobile phone company, is still 70% owned by the Chinese government and only 30% owned by investors. Now, that's not true in every sector of the Chinese economy, but these issues do impact China's role in global indexes, and that's how most of us approach these markets. All of the major global indexes, from the S&P to the FTSE to the Dow Jones to MSCI, the ones that most investors are familiar with, use a principle called free float adjustments. And what free float adjustment does is it takes into account the fact that there are some shares of companies that are simply not for sale. This includes shares that are held for strategic reasons by other companies, or shares locked up by employees and management, or shares held by governments. So when an indexer creates a traditional market cap weighted index, they reduce each company's weight in the index, so it's really only representing those freely available shares. Now, they do this for perfectly good and perfectly honorable reasons, right? I mean, imagine you had an enormous company that had 10% weight in a certain index based on its market capitalization, but only had, say, 1% of its shares actually trading. If there was a lot of money tracking that index, it would force the index funds and pension funds following that index to buy huge quantities of that very small pool of freely available shares, artificially inflating their prices. So float adjustments are really just an indexer's way of ensuring that the indexes are actually investable, that they make sense as a vehicle for people to put their money in. And they apply these to every company and essentially every index anywhere in the world. It's pretty much the standard for how the big traditional indexes are managed. Most of the time, this doesn't really matter. So among U.S. companies, for instance, it's common to see as much as 95% or even 99% of the shares available for trade. So these free float adjustments are actually quite minimal in the U.S. market. One company might gain or lose a few basis points of weighting. But when we're thinking about something like China, this has a big impact. On a GDP basis, and you addressed this in some of your slides, Professor Malkiel, China currently accounts for about 9% of global GDP, which makes it the second largest economy in the world. But if you look at something like the All-Country World Index here, on a non-float adjusted basis, it should be about 7% of global stock market capitalization. But if you apply this free float adjustment, you end up with just 2% of it in your global portfolio. That's about 18% less than Switzerland, and it's half the weight of Canada. And I think most people can look at that and at least raise an eyebrow and say, there's something going on there, I need to rethink this. The deviation kind of works both ways. This table, courtesy of MSCI, shows us the biggest discrepancies between what the GDP-weighted index would look like and what a free float market cap adjusted weight actually is in the All-Country World Index. And these represent two kinds of statistics. First, those free float adjustments, and also the relative development of each country's capital markets. The numbers can be pretty startling, though. The U.S.'s weight in a market cap weighted portfolio vastly outstrips its size by GDP, while countries like China and even Germany and Italy and Russia get cut out. Now, I'm not suggesting that we all run out and move to GDP weighting of our indexes. Right? There are reasons for some of these adjustments, but you do have to ask yourself, if you're looking to buy the global market, are you really getting that in a traditional free float adjusted market cap weighted index? You can see the similar things when you look into any corner of the market. So a lot of investors have gotten their Chinese exposure over the last few years through big emerging markets funds. China suffers from its free float adjustment here just as much as it does in a global index, where countries like South Korea, by contrast, get significantly overweighted. And all of this ties back to the fact that China is just fundamentally different, right? Because of its communist heritage, because of the massive government ownership of its largest companies, its weight in any index-based portfolio is almost always severely depressed. So it's worth considering, I think, whether you want to accept this as the base case or adjust your portfolio on your own to compensate for this systemic underweighting in your international exposure. The second issue with China is really one of share classes and access. Again, because of Chinese unique heritage, the listings of Chinese securities and the availability of those securities to foreign investors like us here in the U.S. Is unique and not that simple. So while there are a couple of nuances, there are essentially three kinds of Chinese shares we need to be thinking about. The first is the so-called A-shares. A-shares are the shares of companies that are actually listed on the stock exchanges in mainland China, either Shenzhen or Shanghai. The bad thing about A-shares is that for the most part, you can't buy them, you meaning a U.S. investor. China keeps very tight limits on the amount of foreign money that can flow into the domestic Chinese equity markets, and as such, there's very little access to these A-share companies unless you're a mainland Chinese investor. Historically, a mainland Chinese investor could essentially only buy into the A-share market, these local shares, until the Hong Kong market was opened up to some mainland Chinese investors in 2007, but with a bunch of restrictions. And that gets to the second class of shares, which are these H-shares. The H-shares are shares of companies that are incorporated in mainland China, but they also trade on the Hong Kong Stock Exchange. And foreign investors can buy these to their heart's delight. And then last, there's the N-shares. N-shares are listed on U.S. exchanges, either New York or NASDAQ. Many of these are ADRs, or American Depository Receipts, which are really just shares of Chinese companies listed in New York. Interestingly, there are actually some companies that only have their shares listed on New York. We'll get to that in a minute. So this A-share versus H-share market does have some impact for investors. So historically, the A-share market was quite volatile, and this chart tracks the so-called A to H premium, which compares the price of an A-share class and an H-share class for a company that happens to have both kinds of shares. And what it shows is that for long periods of time, particularly recently, the Chinese investors, the local Chinese investors in mainland China, bid up the A-shares to levels well above their true value if you accept that the Hong Kong value was the true value. Those premiums, since the markets have continued to open, have collapsed. And some people think that this was really the collapse of a bubble in the domestic Chinese equity market, but regardless, they're much more at parity now than they have been in recent history. So it's important to remember that most ETFs really only have access to these H-shares and not the A-share market. And that's important because there are some kinds of companies that do and don't list H-shares. So giant telecom companies, they'll tend to have an H-share. A smaller consumer play, a little bit less likely to be on multiple markets around the world. You get a similar and somewhat more interesting tweak when you consider companies like Baidu or Renren, which are the Google and Facebook of China, respectively. These are both fast-growing, hugely popular tech companies, and both of these companies chose to list on the U.S. market instead of either listing on the A or H-share markets in China. So they're Chinese companies, but they're U.S. stocks. So while the good news is that that's made these companies available to U.S. investors, from an indexing perspective, this actually causes headaches. So these securities simply don't even exist in many large China indexes and ETFs. So you can get, for instance, Baidu in the NASDAQ 100, but you won't get it in the largest China ETF, FXI, or any fund based on an MSCI index, even though these are important parts of the Chinese growth story in the Chinese economy. It's not entirely true that they're orphans. The AlphaShares indexes, for instance, which are tracked by HAO and YAO, put these U.S. companies back into play. So do S&P-based funds such as GXC, but most China indexing methodologies essentially ignore these companies entirely. So let's look at the ETF landscape briefly before we open it up for discussion. Investors currently have 19 different ways to approach the Chinese market. Each of these ETFs tackles this share class and listing question differently with different results, and we'll hit some of those. There are also other things than equity to buy out there. There are 2 Chinese currency products. We'll touch on those very briefly. And there are 5 ways to play if you're looking for leverage and inverse. We're going to ignore those for the most part in this discussion. Let's instead focus on the 6 ETFs that either provide broad market exposure or, in the case of FXI, which is the largest ETF in the space, pure large cap exposure. I've included FXI because it has the bulk of investor assets. But as this slide shows beautifully, the impact of these AH and ADR issues have a real impact on which funds make sense and which don't. Let's start with FXI on the left. FXI was the first ETF to provide any exposure, and consequently it was first in market. It's become quite popular. It has 10 times the assets of its closest competitor. But if you're actually looking to get exposure in any kind of broad basis to the Chinese economy, there's really no hiding the truth. FXI is a terrible bet. It's not FXI's fault. It doesn't actually claim to be a total market fund. It's quite explicitly saying it's trying to buy the 25 largest H-share companies, the largest companies on the Hong Kong exchange. So buying FXI is a perfectly good way to achieve that strategy, but it's sort of akin to saying you're trying to get access to the U.S. market and buying the Dow 30. You think you might be getting the Russell 3000, but what you're actually getting is this extremely narrow slice. Now, to be fair, the issuers know this. iShares has launched another product, the MChai, which competes with it, and it provides more broad-based exposure. That's a very new fund in the market and has not had tremendous traction to date. But regardless, FXI's mega cap focus is important because it shows you how these sector differences emerged. We just heard Professor Malkiel talking about his bullishness on the Chinese consumer. Well, there's zero exposure to the Chinese consumer in something like FXI. You also don't see exposure to things like materials or industrials or information technology. What it really does have a lot of is financials exposure because all the enormous Chinese banks dominate the top 25 stocks in Hong Kong. You can also see that YAO and GXC, the two most traditional broad-based funds, have a lot in common from a sector perspective. YAO leans a little bit more towards technology, GXC a little more towards telecom. PGJ, another option in the space, has a very bespoke index with unusual tilts in the space. And then last, there's PEC. I mentioned earlier that it's hard to get exposure to the Chinese A-share market. You can do it through this one fund, PEC. It gains exposure to the Chinese A-share market by purchasing swaps from those handful of international companies that have the right to invest directly in Chinese A-shares. It's a bit of a hoop to jump through, and you pay a huge premium to get access to that hoop. The fund currently trades at 12% over its fair value. It's often traded at 20% over its fair value, trading much more like a closed-end fund than an ETF. But if that's really what you're after, you can get that exposure. So you can see exposure to domestically listed companies is very different on either side of this coin. The point here is you can't just buy any old fund. You need to look under the hood and decide which version of China you really want to own. Just briefly, the stats in the space, you can see there are really 4 funds at the sort of magic $100 million in asset level. The other newcomers have had a little bit of difficulty getting traction and maybe a little early to say. Let's see how some of these funds have done. As you might expect, the funds with fairly similar sector breakdowns have performed reasonably similarly. The outlier here on the bottom, of course, is FXI, which you would expect to stand out because it does have quite a different portfolio spin. The leader since the beginning of this chart, which was in October 19th, 2009, which was when the youngest of these funds was launched, is YAO. So let's talk about why we've had some of these differences in performance. I like to take a look at things from a regime analysis perspective. In this case, many of these new, more interesting ETFs are quite new, so I've used the underlying indexes here to go back. If you look at the bear market the way most U.S. investors would probably market, which is be from 2007 to the March bottom in 2009, you can see there wasn't a tremendous difference in performance as things weren't going well in the global economy. However, when you look at the bull recovery that we saw off that March 9th bottom, you see a real separation here between the narrow large cap performance of something like FXI, which would be here at the bottom in the FTSE China 25, and the more broad-based funds. And if you look at, for instance, the AlphaShares All Cap here, which is the index behind YAO, it looks much deeper into the mid and small cap part of the market and substantially outperformed anybody else in the space. The idea here is this rallying from the small caps effect was captured well, and that was really evident globally as we came off that March 9th bottom. We saw it here in the U.S., we saw it even in Europe, and we saw it in China as well. A couple other quick slides. As you would expect, individual sectors inside the Chinese economy perform very, very differently. The point of this chart isn't to try to pick out any of the data, but rather to point out that just like the U.S. or any other developed economy, there's a huge difference between an outperforming sector like tech at the top of this chart since 2008 and real laggards like the infrastructure plays at the bottom of this chart. Right? I mean, it's not that often that you can look at this much data and see an 80% dispersion within one economy. Last, it's worth pointing out that year to date, while the mega caps have limped along, small caps have pulled back substantially, down 14% in the case of ECNS. We've seen these kinds of pullbacks around the world as the small cap to large cap difference rolls out. One last thing before we wrap up. It's hard not to mention Chinese currency, the RMB. Now, as an equity investor, you're inherently leveraged to a rising yuan, but some investors actually want to play that currently directly, and it's been an interesting play for sure. Historically, as probably everybody knows, the yuan had been pegged to the dollar. That peg came off sort of last June, and it has accumulated at a rate of about 5% since. You'll note that this chart has two renminbi tracking products that have significantly lagged the actual return of the spot currency, which you can't directly invest in. Instead, these funds have to play in the non-deliverable forwards market, and those forwards, being forwards, price in some level of expected appreciation, just like with a futures product that shows up in contango and backwardation. And so you can end up with these strange fluctuations where you get significant under or over performance in these currency strategies versus something that might seem so simple like buying the euro. One last point on trading. Folks who've been at our conferences or who have listened to us talk about trading ETFs before have heard us talk many times about the importance of understanding intraday net asset value. I put out this chart to point out that when you're thinking about an economy like China, where the markets are effectively closed anytime you're going to be trading the ETF, these are relevant issues, right? The intraday net asset value for any fund investing in mainland China or in Hong Kong is essentially going to be flat. It's only going to vary by the amount the local ADRs it holds might change, or perhaps any changes in the currency rate. So during the U.S. market, it's really not a relevant thing to look at, the intraday net asset value. Instead, you should be looking at how has this fund historically tracked its net asset value. Pretty much without exception, they've all done reasonably well at that, with, again, the notable exception of PEC, which has continued to trade at substantial premiums to its true value. So that wraps up my thoughts on this. At this point, I'd like to bring Professor Malkiel back in to answer a few questions. A couple of quick housekeeping notes. You can ask questions in the Q&A panel on the right side of your screen. One question I'll answer right off the bat, because we always get it, is whether the slides will be available, and the answer is always yes. The slides and a replay of this event will be available on our website within a day or two. And last, if you're attending this live, the information on CE or CFA credits will be emailed to you to the email address you used to register. So Professor Malkiel, I have a bunch of questions of my own, but interestingly, as we were doing this, we got a question that came in from one of your colleagues, William Bernstein, who was asking about the issue of Chinese dilution. Many companies in China, continue to issue new shares or bring shares off of the books of the government to get them out into the marketplace to raise capital. There have been some academic studies on this. Do you think that this has any persistent negative impact on the performance of Chinese investments?
Oh, I think it probably does, and it could probably be described as the general overhang problem. You mentioned quite correctly that for banks, telecom, oil companies, the government owns a big chunk of the shares. In fact, as you mentioned at China Mobile, a majority of the shares. Now, the government has made all of the shares tradable, and the government would like, they know that capitalism works. They would like to have more of these shares freely trade in the market. And what that means, as the question implies, is that you've got an overhang of shares. It's a little bit like, say, buying General Motors today. You might think, boy, I really want General Motors. I think the U.S. car industry is going to come back, but there is an overhang of government shares that you know they're going to sell in the future. So I think it does hold prices back. And the question, though, is, since I don't see any evidence of a bubble in the share prices, I see rather PEs at world levels or below and PEG ratios below world levels. The question is that already in the price? It is a negative, and in my view, it's probably one of the reasons why, other things being the same, the PE multiples will probably be a little less than they would otherwise be if that overhang wasn't there. Having said that, though, I think that as the growth continues in China, even with PEs staying at present levels, it seems to me that returns ought to be pretty darn good.
And you commented in your slides about sort of the shifting source of that growth, right? The move from an export-driven economy to one that's more internalized. We actually had a couple questions come in from the audience on this. Someone asked, you know, are you suggesting that domestic consumption will actually outpace the global consumption of Chinese goods? I mean, do you think it becomes that dramatic where it
Absolutely. I think there's no doubt about the fact, and you see it already, that within the sectors of GDP, let's take three main sectors, investment, the export surplus, and consumption. Consumption is growing very, very much faster than investment and the export sector, and I believe that that will continue. And it's frankly one of the reasons why in our Guggenheim AlphaShares ETFs that we have probably a higher weighting in the consumer and the technology sector than in others. And let me just go back to Bill Bernstein's question, because there's another very important thing to think about. A lot of the big companies have huge government ownership. One of the nice things about HOW, which is our small cap ETF, is that you tend to get companies that are much more private, which means A, they're more entrepreneurial, B, you don't have the governance problems of a huge government ownership, and you avoid some of that overhang problem that I think one must admit is, other things being the same, not a good thing for the stockholders. So, again, I think it's very important to think of these things, think of the changing structure as you pick the way in which you would like to access China through ETFs.
So, just, I mean, I get what you're saying about moving into the smaller companies that don't have these huge overhangs, but I have to say, it's, you know, we get these phone calls from advisors all the time when we talk about China or emerging markets. There's, I think, legitimate concern from some U.S. investors about the governance of those markets. I mean, one of the fundamental premises of the efficient market hypothesis is that the market is efficient, and a market can't be efficient unless everybody's working with information and playing by the same rules. Do you feel like when you're looking at something like China small cap stocks that those markets and those companies are playing by the same rule book? I mean, we all read some horrible headlines out there about, you know, Chinese companies with a factory that's made out of cardboard, right?
No, absolutely, and that I did mention that in my remarks. In general, if you have had a company that listed directly in Hong Kong, which is pretty darn good listing standards, or with the SEC, in general, those are not the companies that have had the problems. The companies that have typically had the problems are the ones who got into the U.S. market through what's called a backdoor listing. What happens is you've got a very small, say, NASDAQ company that was kind of limping along. You have a Chinese company that then buys it. You've still got the NASDAQ listing, but the due diligence that the SEC did was lacking, and it's those reverse mergers that have largely been the problem. And you're absolutely right; they've been a scourge, and I think you're going to see, you've already seen, the SEC is going to come down against these things like a ton of bricks, and I think you will probably see a lot of those things delisted. And as I said, that's one of the reasons why in our ETFs we just simply say we're going to avoid anything that's been a reverse merger, because you're absolutely right. Those are precisely the companies where the trust is very much less.
Right. I mean, we have a couple questions on the sort of small cap premise here from the audience as well. I mean, I showed that sort of chart of the small caps leading us out of the rally and having faltered recently. Are those charts relevant given that so many companies are simply not listed on the Hong Kong exchange and may not be available for investors? I mean, if it's truly a small company, are they going to be able to afford to, for instance, list HShares and NShares? Or do you need to be trying to figure out how to access the A-share market in order to get the smaller, consumer-oriented, high-growth companies?
Well, I think you can actually, from a standpoint of the industries you want and the consumer emphasis that you might like to have, I think the answer is that you can pretty well get that through the H-share market. I don't think that's really likely to be a problem. And very frankly, if you're worried about the reverse mergers, and you are worried about the governance, and look, the rule of law in China is this is an ongoing, developing thing. It's not there yet. The China would like to make it there. They would like to have these legal protections. They know it's important, but it's not like it is in the United States. And if that is what you are worried about, that would be another reason why one probably would like to be should not, even if you could get some of these companies as A-shares and not H-shares, it ought to make you a little bit wary of the A-share market. But as I say, I think our analysis has shown that you can pretty well get the kinds of things that you like through the H-share market. I mean, you can get the largest Chinese sneaker manufacturer, the one that Shaquille O'Neal is the spokesperson for. You can get the rice cracker companies. You can get the packaged noodle companies. You can pretty well, I think, do that through the H and N share market. And as I say, I've just avoid the reverse mergers, but the ones that were directly registered with the SEC are clearly the ones that are more transparent and less likely to give you the kinds of problems that have been so much in the news in the last couple of weeks.
Right. Couple more quick questions before we run out of time here. We have a bunch that are really, I would call, sort of at the economic level that seem right up your alley. Part of the story of the rise of the Chinese consumer has a couple things going on. One is this implied rise of the middle class, and the other is a rise in the average wages, the standard of living for that middle class. that inevitably, one would think, impacts their ability to be the world's exporter, the world's manufacturer. What are the dangers of that transition, right? I mean, it seems a little Pollyanna to think that they can make this transition from a less paid workforce to a higher paid middle class that can then engage in this internal consumption without some major hiccups in the road. I mean, what should we be looking at as investors to see whether that transition is working well?
Well, I think there's no doubt that it means a considerable adjustment. And let me give you an idea of one of the adjustments that China's going through right now, and it is a hiccup. I don't think I'm an index investor, so I'm not going to try to tell you that there are certain companies you ought to be in and not in, but certainly the textile industry in China is going through some tough times because wages are rising, and China is losing its textile industry to Malaysia, to Cambodia, to Vietnam. I mean, that's part of economic development. I grew up as a boy in New England. We used to make textiles in New England, and then we lost the textile industry to the non-unionized South, and then the South lost it to Latin America. That is, these are, and I'm not going to tell you, these aren't tough adjustments, and it's going on now. The textile industry has suffered greatly. All I'm suggesting to you is that with the enormous savings that there are, that there is an enormous amount of room for consumption, which is a third of GDP, never to be 70% like it is in the United States, but to have it be 50% of GDP, with people happier because they're consuming more. That's the kind of adjustment that there is. Am I going to tell you that that's an easy adjustment? And if you were a textile worker in Harbin in China, that you might not be happy because you've lost your job and there's an adjustment period that you're going to have to go through? Absolutely. But that is the cost of a dynamic economy, and I think it's simply inevitable.
Right, and inevitably those kinds of adjustments are the sign that those transitions are working, right? I mean,
exactly.
If you don't read the headlines about that, then it means that something's not working.
Yeah, I think that's exactly right.
Unfortunately, I think we're out of time, Professor Malkiel. Thank you so much for taking the time with us today. It's been very enlightening. I'd remind everybody on the phone that our next session will be on July 12th, which is on how to trade ETFs. Thank you very much for joining us. Have a great day.
Thank you. Goodbye.